The number one broker advisor lie about annuities actually isn't even a lie about annuities, but rather a lie about the open markets and a critical omission about bonds as part of a diversified portfolio and how bonds protect against stock market volatility. But instead, Mr. Annuity Salesman uses scare tactics. He'll talk about how if you put your money in the stock market, you're risking it all in the Wall Street casino. And often commission-based advisors will encounter senior citizens who put all of their money in the stock market from 2000 to 2008 and they lost a lot of money. But the conversation they should have with them is, oh, you failed to diversify into bonds. You were taking on way too much risk for your age and considering the fact that you're retired. And they should say to them, have you heard the phrase, when stocks fall, money runs to the safety of bonds? But they don't. Instead of having this conversation, they proceed to present these senior citizens with a false choice. Either continue to risk your money in the Wall Street stock market casino or invest in this annuity that I want to sell you. They never present to them the statistical data showing them that if you were diversified, for example, in 25% stocks and 75% bonds, you weathered the 2000 recession just fine. In fact, if you go all the way back to the 1930s depression, when accounting for deflation, at no point did you lose money. And they never present to them this chart, which shows you that from 1970 to 2010, the lowest risk portfolio was not 100% stocks, but rather 28% stocks and 72% bonds. Now, will a 28-72 portfolio turn out to be the lowest risk portfolio over the next 10 years, 20 years, or 30 years? Nobody knows exactly, but with history as our guide, you can expect that it's probably going to be somewhere in that neighborhood. This is also not to say that taking the lowest risk is the best strategy for you right now. Also, when comparing these returns to the annuity that some advisor is trying to sell you, beware that these guys are often ambiguous about talking about return or annual return, which is not the same as return on investment. The only return that matters is return on investment and after taxes are applied. For more on this, click the link you see on your screen.